On this one, I don't know. Sorry, Chuck asks, is there a way to display IVR in a grid column? If not, can you please add it to your wish list? We show the percent implied volatility range for most strategies. I don't think it's available in credit spreads right now. But for looking up the covered calls, naked puts, other positions, I know this is, sometimes it can hurt the eyes. Yeah, I don't have the implied volatility range in this strategy. But for many other strategies, let's say covered call search, many of the single strategies, including straddles, Chuck, strangles, and more in that case. I thought I already had it added, but I'll go to add, remove columns again. Slide that on over, Chuck. Percent implied volatility range. That's what we use. You said IVR. We use the percent implied volatility range. It's showing you where the option's implied volatility is today compared to where it has been over the life of the option as well. Okay, so in most strategies you can add that. You can add that in the option chain as well. Not just the percent number, but also the actual range. That should be in here somewhere. I know it's definitely on the chain, so what I mean is you can look at the percent implied volatility range and you can see the actual range as well, in addition to seeing the IVR. And I think I had that on my chain, if I'm not mistaken. I went to default. Oh, no, there it is. So, yeah, for my chain, I've got the actual implied volatility range of each individual option, and then the percent IV range as well. Ignore that saying 0 because that's today's expiration. That's the numbers you wanted to see there, okay? IV range and percent implied volatility range, Chuck, right there. Craig had said, Mike, I have been a Blueprint owner for several years and have used many of the income methods. The Blueprint, of course, is the full work that describes our married put approach, the structure that we prefer to use with the 12 different income methods. Okay, so that's what Craig's referring to here. So the income methods. Recently, I have been using IM6 and found that it yields small but consistent profits, whether the stock price declines, stays flat, or advances. In fact, it seems this income method doesn't lose. Oh, it can. But this can't be true, can it? Yes, it can. Thanks in advance for your response, Craig. All right. I had another gentleman that I had an email discussion with for the past few days, Bernard, actually, who was asking a similar question. So what are we talking about here? Well, last week we talked about the married put. I can't remember the gentleman's name that was asking about using income method number 1, selling a call against the married put position, of course, and you know, when to look to roll it, when to look to adjust it in that case. So I can't remember. It wasn't Bill. In any case, what are we talking about here? So if I went into the married put search, I'd see a list of trades that I'd likely open. I almost opened this one, but I didn't open Jabil. I opened HDS instead, which was actually performing better. JBL was performing really good at one point, and then HDS started to do a lot better than the position. Okay, scanning here. I think I like this Taiwan Semiconductor one the best, although Target is good. I'm looking at prices, not really saying that one of these stocks is better than the other. Qualcomm or Target? I'll stick with Target. Okay. Again, not a recommendation or suggestion. I'm just saying based on the prices. So, if I was opening a married put today, I'd probably open Target here at around 117.02, and I'd look maybe out to the 125, the 2021, excuse me, April 125 put for around $19, cost of $18.88. This puts my cost basis up to $135.90 per share, but I'm guaranteed to get 125 back. That's the benefit of the put, so we're only risking 8% on the position. Now, one thing we typically never do is do an income method or adjustment right away. Many of you have heard me go through the details and explanation as to why. If I open this married put, by the way, my expectation is, because I have a stronger feeling on this stock than the others who are in the list, that this has the potential to move up, let's say, 3 to 7% or so in the next 20 to 40 days. Okay, so it'd move up maybe 5 or 6 points, up to about 123, near my put strike price. Let's take 123. as an example, okay? And let's say we do get this in 20 days from now, 25 days from now, so out to, let's just say July, it's 20th. Why not? Somewhere between 20 to 30 days from now, 20 to 40 days, all right? Now, if that's the case, without doing anything, my expected profit would be around $126. Okay? It should be higher than that. I think the volatility is fluctuating with this. I don't expect to see that big of a decline here on this target put if the stock moves up 6 points. That seems excessive. Usually it's about half. But in any case, so I'd expect to lose 300, not 472. But in any case, because this chart's using the same volatility, I should take that into account. So we go up to 123 in 30 days, and I get a return, or I see a profit of 126. Now, the stock trading where it is, I want to get some premium right away. So let's go 14 days out again, and I want to get some decent premium. 125 is only 50 cents. I want better premium. I want $1, right? I want $1.10. Yeah, let's go with the 121 strike call. Okay, and we'll go ahead and sell that call there. And so we get 134. Lowered our cost basis. Wait a minute, that's wrong, isn't it? That can't be right. How did my risk go up? I generated premium. Well, the risk went up because we sold the call at too low of a strike price. Anytime you sell a call below your put strike price, you essentially create a bearish position where you increase the risk to the upside in the direction you thought the stock was going to go, not to the downside. The downside risk was lower. But here's another thing. If the stock's trading right at 121, I'll get a profit of potentially $180 or 1.3%. Hey, that's better than the 126 I'd get. But if the stock goes up to 123, I'm looking at a much smaller profit of probably only $50 or so. Whereas opposed in the married put, I'd have the higher profit of 126. What's the way to solve that? Well, number one, you don't sell a call below the put strike price, even in what we're going to show next. And if I was bullish on the stock, why do I want to sell a call for so little premium and cap the upside gain? I don't. That's why I don't do an income method right away. One of the advantages of income method number 6 is that it's a bear call credit spread. But done in the context of stock ownership, it's like a covered call with an extra long call that leaves the upside open. So, and pick the right expiration. Let's say I bought this 121. Sorry, I sold the 121. We're going to stick with that. And I bought the 125. All right, so now I'm paying 50 cents out to have this extra call sitting out there. So I only get 84 cents of net credit. But look what it does. It bounces here, and then it leaves the upside open. This is an incorrect structure and why I would never do it. Because the one thing I don't want to do is enter into a negative field of risk again. Because where was my target? My target was right here, 123, 124. Well, I'm in a loss zone if my target's hit for my original expectation. Sure, I got 84 cents, but I'd still turn the position into a loser because I'd have to pay $3 or $4 to close this or risk getting assigned on the stock. Okay, that's how income method number 6 can go against you. But for face value, the gentleman I was talking to via email, Bernard, I believe, was looking at similar shorter-term trades, structured correctly, but for a much smaller net credit. Now, what do I mean structured correctly? Well, I have to start at the put strike price so I don't go negative again, and maybe keep a wide 5-point spread. Okay, this might be what Craig was saying as well. Okay. Now, what's the deal here? Here I'm only collecting 35 cents of extra net credit, and if the stock is trading in this range, I'm looking pretty good. Okay, and in this case, it could, if it jumps up really high, if it does go up to 130, I'm still making about, what, $100 here, $110 on the position, where you'd probably be making closer to $300, $400 if the stock hit 130 with just the married put. That's a liquidation. Okay, so the other gentleman was asking me a question, and Craig, it's been working out for you in these market conditions where things have been going up, and then, whoa, whoa, whoa. Okay, things are back and whoa, 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 something coming up here. There's the 1800 Dow fall. Here's the 3 days this week, right? So looking at that, this is a good time to be using income method number 6 because you start to build up, and if you catch the upper side, you know there's going to be some hesitation. You know there's going to be something, and it pulls back. and your income method number 6 is looking pretty good, and then it goes up, it gets a little threatened, you're thinking about rolling this one so you don't get assigned, and then, hey, oh, the market pulls back, now we're back into a safe zone. The last 4 weeks might have been a good time to be doing that. It's not consistent, though. It's not something that you want to do consistently, because depending on your structure, depending on the situation, this run from 90 to 110 would not have been a good idea for income method number 6. Yes, you would have left the upside open, but you would have left 4 or 5 points on the table between the strike prices. Up here would have been a great time to do it. Do it right here at the peak if you caught it. And it pulls back here, moves back up, but still below the strike prices probably. That'd be a perfect time to do it. This, not so perfect. I don't think I agree with that. That would not be a good time for 6, even though my upside is open, because I probably would have done something here, maybe the 115, 120, or maybe even the 110, 115, and now I've got to cover that 5 points or manage the position at a debit, which is going to add to the risk on the bear call spread. Oh, but look right here. Perfect time to do it. Little dip there. Right here, perfect time to do it. Right here, looking like a perfect time to have done it. I agree with you, but it's these runs up, these 3 runs up, that it's not the good time to do it, because you'll be adding to the risk trying to manage out of the income method number 6 trade. The other gentleman's approach, he was asking me, well, if he went all the way out to, I think it was just on SPY, I can't remember, but he was saying that, look, Mike, I don't get it. Why can't I do this? I buy a January 2021 put, or maybe further, a leap put on an SPY position or a position. And then I sell an income method number 6 that's structured properly at the put strike prices, and I just sell it every week or every 2 weeks. I'm getting $200 in, 20 cents times 10 contracts. I'm getting $200 in, and I've got to cover a risk of $3,000. And, we're 240 days out to expiration, so if I do this every week, I've got this certain number of right cycles, and that should cover the risk. But again, you're going to have to manage them at some point. You did a 5-point spread and got 50 cents if you're lucky. If you try to force the income method number 6 right away, as we just showed, using the proper structure so you don't go negative twice, oops, I'm sorry about that, you're getting, what did I say here, 35 cents, 40 cents in this case. Okay, so you're getting a little bit of risk, and if you do that every 7 days, you're taking off 0.2% each time. If you've got enough weeks in there, you can pay for it. But the minute one of them accelerates up and you've got to manage this short call to avoid assignment, and you maybe close out both and you take that 5-point loss, you took 35 cents in initially. Yes, you have more on the stock. That's true. But still treat this as a spread. I made 35 cents 8 times, right? Let's say 8 times. Oh, I'm sorry. No. I'm really sorry. It's more like 18 times. My apologies. So yeah, the stock goes up at one point. It goes up above that upper strike price and this income method number 6 trade. Now, I might still be obligated to deliver shares of stock here that could buy it at 130. I could let my broker do that. But again, that's going to change my effective cost per share. My cost is going to move up from 117 to 130 at the long call, 13 points. I get 400 points of profit here, so I've added about 9 points to the cost basis of the position. Or I close the spread. The stock's now up at 135. I close the spread. I've made $18 just on the stock, lost maybe $9 on the put if it's trading up at 135, but then I gave back 5 points minus 35 cents to 465. So I'm not realizing as much as the upside in that case. I don't think it's a great approach, because there will be times that we saw, for example, on the stock chart where you will have to close out of that 5-point spread. You'll see sudden runs. Okay, we will have to close out of that spread, and that's going to add to your cost basis and add to the downside risk, not keep removing it. But as you said, you've picked the right times where you've had the great, that's a good move there. That would be a good move there. This would have been a great time for an income method number 6. 1 week out, 2 week out, or 3 weeks out. Here would have been a great time for an income method number 6 as well. 1 week out, 2 weeks out, possibly even 3 weeks out, depending on what happens next week. This would not have been a good time. This would not have been a good time, and I don't think this right here would have been a good time. Maybe here to there, but if you tried to do it here, it would have hurt you in that case. So remember, you will have to buy it back. You will have to adjust that short call to avoid assignment or close out the spread for the full points, okay? Okay, so that's my thoughts on that, Craig, is that I just, that's the risk involved in it. You've picked right times, okay? And I know this is an example. It's not the best example, but it's just an example where I can see where it likely wouldn't have worked and added to my overall risk by 4 or 5 points at a time instead of subtracting 35 cents from my risk 1, 2, 3 weeks out and so forth, okay? So it's not something I prefer to do. If you feel strong enough that the stock is going to move up a little bit but hesitate, I'd prefer to wait for that movement, then do the income method number 6 to get the best premiums at the better strike prices. And again, always graph it first. Don't sell, even though you're in an income method number 6, where you have the spread that leaves the upside open in the married put. Don't sell the short call below the put strike price, because that could come back to haunt you, where if you hit your target, you're still at a loss because of the improper structure. You now have 3 ways to lose. To the downside, if the stock went up to the price you expected, or if the stock went up a couple points above the price you expected, you might still be in that little loss zone that we saw in the previous position rather than being at a profit. You got to make sure the structure is correct. But also, yes, you're going to have runs on those, and you're going to have runs from time to time. And that's going to have you to close this spread in that position. We just haven't been encountering them in the past 6 weeks or so, or I'd say 4.5 to 5 weeks. Okay. All right. We did have some great run-ups, though. And the target chart was good of that, too. Sam adds target. Sam feels, this isn't my suggestion, but you know, Sam offers his trading and is very smart with his trading and watches the market honestly more than I do. But Sam's thoughts here is target's going to bounce likely off of 117, and 117 is a strong support. It looks like there's a confluence at 116.58 according to Fibonacci. Might need, Fibonacci ratio. Target need a strong upside market move next week to break through that, I believe. That's what you're saying there on the confluence. Okay. Khokon already has a set idea in mind of a trade, and he says, please explain using PowerOptions tools to enter a bull put on Clorox, July 24th, 202.50, 197.5. Okay, well, if I wanted to open a bull put credit spread on a specific stock, I'd go into bull put credit, and I'd go to search by symbol. Right, I'm going to type in Clorox, CLX, and say July 24th. Okay, so I'll go to July. And let's just go to more results. Now this tool is going to pull up a lot of various 2.5 point spreads on me. This is the 17th. Okay. So I might have to look at all weeklies in that case. But anyway, this is where I would start, the search by symbol tool. And it would show me these positions. And I could compare the different probabilities. You said the 202.50, 197.5. Let me find it. 202.50, 197.5, 81.8% probability with a 13% return. Not quite in my wheelhouse. I'd want to be up here at the 86%, as I mentioned, above 85, and I'd be looking, though, for a 12 to 13%. So this one's close, but it's not what I would choose. However, it's still above 80% probability with a strong 13% return, a 201.93 break even on a stock trading at 215.30. Okay, and then of course I do my further research and analysis, look at the stock chart, company information, which you've probably already done if you're using the search by symbol tool here. But then I could go to the profit and loss chart, and I was going to go here anyway because you said the different expirations. So here, going to the 17th of July, there are 202.5, 197.50 spread Khokon, 13% return, 81.8% probability above. All right, so now I know where I stand on that one. Could run my what-if scenarios, but let's go back here. And let's go to year date, July 24th. I could build it right on the fly from here, 202.5, 197. Excuse me, folks. Sell to open. It'll give me the midpoint price for both options. All right, there we go. And now this one, you have a 19% return, 80-cent net credit. And let me just take your short option. I'm sorry, research and option research. And a 78.4% probability above. Okay? And so we have a lower probability because there's more time at the same strike. More time you get, the probability lowers because there's unexpectedness that could happen in an extended time frame. Okay, but we know we're looking at a 19% return with a 78.4% probability, whereas if I went back shorter term, I'd be looking at a 13% return with an 81% probability above. Okay, so that's what I would look at there. Of course, you may want to delve deeper into some of the concepts and ideas here on this. So what this is showing me, of course, is changes in the option bid versus implied volatility since this option has been released. And I could choose to look at, say, option bid versus stock price, last price, delta versus probability, which would be probably a very similar chart, for example. But you can use the scrubbers here and the sliders to zoom in, zoom out, way out, and look at the different date ranges there and comparisons. You get an idea of where the implied volatility has fluctuated to. Actually, it's been declining here drastically from where it was, and that makes a lot of sense. You know, beginning of June, higher volatility in that case as well. All right, so we have our two spread positions. Which one suits your needs? Now, if I wanted to know which 80% probability or higher, and this one wasn't, so we'll say 75%, Khokon, which 75% or higher probability trade gives me the best net credit and best return on Clorox anytime over the next 3 weeks, I'd actually just use the search. All right, so instead of the search by symbol, I'll go into search. I'm going to clear out all the filters. I'm going to set my expiration date to be between at least 8 days out in time to 40, for example. I know I want a percent return of greater than 12. I want a probability of greater than 75%. And yeah, I'm going to want a decent net credit of hopefully at least 45 cents. Now, let's put it down to 25, so we might even see some 2.5 point spreads there also. All right, don't need to worry about delta. This is my minimum target, 75% probability, 12% return, net credit of 25 cents. Then we'll go into the stock fundamentals, Khokon, and I'll just screen against Clorox. All right, so we've got 24 total trades. 35 days out, the 31st of July, 200 to 197.5, 55-cent net credit, 28% return, 78% probability. All right, so as the returns get lower, what does that usually mean? The probabilities are getting higher. All right, so you got 35 day outs, the 21 day outs you mentioned, 28 days out for July 24th. There's the 202-195, which is a 16.7% return with a 78% probability, as opposed to the 18% with the closer strikes. There's your 202.5, 197.5, 19% return, 78% probability. Here's a 21-day out, 17th of July, 205, 200, 20.5% return with a 76.6% probability. So depending on your probability range, what you're most comfortable with and what return you're targeting, you might have some better thoughts here. You might quickly be able to see it just by using the search tool and using that function search by symbol under the fundamentals in that case. Okay, so that's how I use it to identify the bull put credit spread. Search by symbol is a great place to start. Then you can compare the what ifs, on the custom spread tool that we were looking at there that I got rid of for the different positions. Let's just go back. There we go. Okay. And so, now you've got your comparisons. You can run your what-if scenarios down here as we did earlier in the presentation for that different position as well. I could come in and put it in manually, just like you did, and then you could use the more information buttons to link to the option research to look at that implied volatility range of the specific sell option, the probability or delta or any other Greeks you wanted to analyze right there on the fly. Or you could just create that bull put credit spread search based on what minimum criteria you wanted, and then just screen right against Clorox to see the different combinations of probability, return. You could add implied volatility, as we mentioned earlier, implied volatility range, to see which option best suits your need on the time frame, your desired time frame, your probability, desired net credit, and desired return. It's the easiest way to do it. Search by symbol tool is very useful and very powerful, and that's available in all strategies. But sometimes if you just want to take a stock with a lot of strikes, even SPY, for example, and you want to see the comparisons of any spreads with an 80% probability or higher for the next 1, 2 to 3 weeks out, so you can compare the returns to probability ranges of those positions, using the search tool is the fastest and easy way to do it. Put in your basic 3 or 4 criteria, including your time frame or strike difference if you have a preferred strike difference. Mine's always greater than or equal to 2. Yours might be less than 2. It's perfectly fine. Put all that in, and then go to fundamentals, put in your stock symbol SPY, TQQQ, for example, or UPRO. I mean, you could do this on the covered call screen, put in the basic criteria you want for downside protection, return, and time frame, and on the covered call screen, go into fundamentals and put in TQQQ or UPRO. We use the option chain because I thought it was faster as an example than going through the steps of the search. But you can analyze those returns, premiums, and more on one table here with the different expiration dates for TQQQ, just as we did for Clorox here on the bull put credit spreads. All right. Okay, well, ladies and gentlemen, we are at 5:49 p.m. Eastern Time. According to my empty question pod, I've so far cleared out all the questions there. If anyone has any last-minute questions, I encourage you to go ahead and send those in. And let's see here, just in case we don't have any last-minute questions, I'm sure one or two will come in. But before that, I just want to remind everyone, naturally, as we always do, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or suggestions from myself, Mike Chupka, the Director of Education here at PowerOptions, or from the Power Financial Group or staff at PowerOptions. I'm not planning on opening a bull put spread on CLX, although I think it's a good stock, and that's why I have that leap call in it. I'm not saying that if I did open a bull put credit spread on CLX, it would be the one that Khokon asked us to look at / analyze. It might be different strikes with a different probability based on my trading goals. We appreciate the comments from Sam related to his discussions on what he was doing with the Apple bull puts and looking at Microsoft stocks and well, but I'm not saying that I'm opening any bull puts right now on Apple or any calendar spreads on those two stocks at this point. So I just want to always make that clear, just in case I have to defend myself later. All right. Now, in addition to that, of course, if you like some of the tools that you saw in today's presentations, just remember, go ahead and go to powerop.com and sign up for a 14-day free trial. Just put in your name and email address. You'll have full access to the search tools, those portfolio tools we looked at, the custom spread tool, and more, with no credit card or billing information required. As we mentioned at the beginning of the presentation, you can, of course, as a trial member or subscriber, schedule a coaching session at any time. That's essentially a 35, 45-minute phone conversation with myself or Ernie, walk you through the tools on the site, and answer any questions that you have. Subscriptions start at $45, only $45 for the end-of-day service on PowerOptions after the trial ends. Most popular service is probably the delayed service, 15-minute delayed data or so, and that's $65 per month. We do offer an upgrade from the delayed data. It's only $35 more to get access to the historical service and the historical backtesting tools. And of course, we do offer a real-time service as well. As mentioned earlier, checking out that 8 ways to manage a bull put credit spread or manage your broken position webinars, go to the webinars page at any time, powerop.com/webinars.asp. Again, if you're on a trial or you're not logged in as a subscriber, those first 5 webinars in those sections for options concepts, requested topics, and option strategies may be blanked out, but you still have about 20 to 30 in each of those categories that you can access and go through. Of course, you can always check us out on YouTube. That's where we've been posting most of our presentations in addition to PowerOptions. Only one or two get posted to PowerOptions. Most of them are all on YouTube. You can just go to YouTube, look for PowerOptions, and you can check out the recent videos there as well. You can actually, I try to title them all based on, are we talking about a debit spread, credit spread, so on and so forth. So you can run a search just for bear call credit spread or bull put credit spread on the PowerOptions YouTube channel. You'll see all the videos that relate to that topic. All right, and if you think of any questions later on, remember you can also send me an email at any time during the weekend. You can send an email to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. All right, Eric, I'm glad you enjoy them. Eric says, I truly enjoy these meetings. I feel I learn something new each time. Thank you so much. Eric, you're welcome. Thank you for joining our conversations and participating with us. And it's great to hear that you're learning something and that you're enjoying it. See, William says, thanks again for a great webinar. Have a wonderful July holiday weekend with your family. Yep, William, you too. We're looking forward to that next weekend as well in that case as well. So I hope you enjoy the extended weekend next week as well. Remember, one last time for those online, adjust, roll, or close your positions by Thursday at 4 p.m., Thursday, July 2nd. The markets will be closed Friday, July 3rd. So if you have anything expiring July 3rd, make sure you take care of it before July 2nd, for Thursday at 4 p.m. All right, Sam, thank you. Thank you so much for sharing your trades with us and for your commentary and for helping out with the covered call question for Amin and the spread question as well. So thank you, Sam. You have a great weekend also, and be safe. Chuck, you have a great weekend too. Thank you for joining us. We'll see you soon. Take care, everyone. I hope to see you on the next time, and I'll let you know as soon as these webinars are available. Take care. Good night.